My fellow Americans, this is Liberation Day. I'm waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again.
It's been a little over a month since U.S. President Donald Trump upended the global economy with a huge onslaught of tariffs. It's been a wild ride. Within a week of so-called Liberation Day, most tariffs were paused, while those on China were ramped up to 145% before a deal was struck. Markets have reeled and since bounced back. Uncertainty abounds. Take the U.S. dollar. It has slumped sharply since Trump's inauguration in January, losing value against other major currencies. Big announcements have been followed by sharp dollar falls as investors lose faith in the currency and the U.S. economy in general.
Unintended consequences are part of a deeper plan. Many in Trump's circle believe the dollar is overvalued, and its strength is responsible for many of the issues they want to address, from trade deficits to deindustrialization. And some believe that Trump's team are eyeing an alternative grand bargain in order to reshape the global financial system in America's favor.
So is there a philosophy behind the chaos, or is it simply chaos? It's coming up on Business Beyond.
Speculation that Trump has a radical plan to upend the global economic system has been rampant. It's an idea that goes beyond tariffs. It's about convincing other major economies to devalue the dollar.
A major catalyst was this, a paper published in November 2024 by the investment firm Hudson Bay Capital Management. It said Trump's return to the White House put America on the cusp of generational change in the international trade and financial systems. It suggested that rather than face punitive tariffs, trade partners like Europe and China become receptive to a quote-unquote currency accord. In other words, that the tariffs simply be used as a bargaining chip towards dollar devaluation. And it gave the potential agreement a name, the Mar-a-Lago Accord. The idea being that the great nations of the world would meet at Trump's Florida base to thrash out a deal on global currency exchange. A paper like this could easily slip by unnoticed, but this one got people talking because the author was Stephen Miron, now Trump's chairman of the Council of Economic Advisors, right at the center of policymaking in the White House.
In his pitch, Myron referenced big moments in economic history where currency rules were agreed at grand gatherings. And it is true that rules can change quickly.
One of the most well-known summits came at Bretton Woods in New Hampshire towards the end of World War II in 1944, where Allied nations forged a new financial system. The Bretton Woods Order established stable exchange rates between currencies and set the US dollar as the world's main reserve currency, used for most international trade. It also established global financial institutions like the World Bank and the International Monetary Fund. Crucially, the system enshrined the gold standard, which pegged the value of currencies to gold. In 1971, the so-called Nixon shock saw President Richard Nixon end dollar convertibility to gold. Major currencies were soon traded on floating exchange rates. But by the mid-1980s, the US dollar was seen as seriously overvalued amid strong economic growth and large trade deficits. At New York's Plaza Hotel in September 1985, the then G5 nations of the US, Japan, West Germany, France, and the UK agreed a major intervention in currency markets to depreciate the dollar against their own currencies. It became known as the Plaza Accord. Now in 2025, many in the Trump administration favor a similar redrawing of the international financial order.
Myron argues that for decades, the US dollar has been too strong, mainly due to its reserve currency status, and that has made American exports too expensive, leading to massive trade deficits and deindustrialization.
There are various ways of measuring the relative strength of the US dollar. One of the most reliable is the Real Broad Dollar Index, used by the Federal Reserve. It's weighted by trade volumes and includes many other currencies. Looking at its progression over the last 20 years, we can see that since the lows of the financial crisis in 2011, the dollar has been getting stronger and stronger, despite a few bumps. Before Trump took office, it was at its strongest point since this measure began in 2006. A more long-term measure is the US dollar index. It's not weighted by trade and measures the dollar against a few other major global currencies. It surged in the early 1980s, leading to the 1985 Plaza Accord. It fell sharply before rising again in the late 1990s amid the Asian financial crisis. The dot-com bubble crash in the early 2000s prompted another fall, as did the global financial crisis, but since then, the dollar has been on an upward curve.
We approached Stephen Myron for an interview, but he wasn't made available to speak to us. However, in a speech he made at the Hudson Institute last month, he explained how the global demand for dollars has led to imbalanced international trade.
The reserve function of the dollar has caused persistent currency distortions and contributed, along with other countries' unfair barriers to trade, to unsustainable trade deficits. These trade deficits have decimated our manufacturing sector and many working-class families in their communities, to facilitate non-Americans trading with each other.
Central to his argument is the reserve currency rule. Countries like to hold foreign reserves for various reasons, and they want to hold them in a dependable currency. The US dollar is undeniably the world's reserve currency. More than half of all foreign reserves are held in US dollars, leaving it way ahead of the euro in second place. It's sometimes suggested that the Chinese renminbi could emerge as an alternative reserve currency, but current data shows just 2% of international reserves are held in it.
Many economists agree that the dollar is too strong, but there are disagreements around the reasons for that and its consequences.
I dislike the Myron piece quite strongly. I think it's wrong-headed.
That's Mark Sobel. A veteran U.S. Treasury official, he worked in international financial diplomacy for much of his career and is now the U.S. chair of the Official Monetary and Financial Institutions Forum think tank. He agrees that the dollar is exceptionally strong, but thinks it is more to do with the U.S. government's need to borrow big to finance itself and service its huge debt pile, rather than its global status as a reserve currency.
And Myron talks about the dollar's reserve currency status, but he doesn't really talk about the need to get our fiscal house in order. And then the Myron article kind of implies that the dollar's global role is bad for America. Now, in Europe, they always talk about the dollar's exorbitant privilege, but Myron implies that there's an exorbitant burden. I don't think it's either of those things. I think it's a net plus.
The U.S. has a massive federal debt burden, and it's getting bigger. The U.S. government spends a lot more money than it takes in through taxes and other revenue, and borrows heavily to meet its obligations, which can push up the value of the dollar. Since the COVID-19 pandemic, annual deficits have swelled, and they're projected to remain at around $1.5 trillion annually for the next few years.
Myron also talks a lot about trade deficits, something Trump and his team say the tariffs directly target.
Someone who agrees on trade deficits is Richard Koo. Currently the chief economist at Nomura Research Institute in Japan, he has advised several Japanese prime ministers and worked with the Federal Reserve Bank of New York in the 1980s, just before the Plaza Accords were agreed.
For a very long time, this trade deficit, caused largely by the strong dollar, was left unattended. And it was Trump's genius to find out that there were so many unhappy people there. And once he started talking about protectionism, suddenly he began to attract huge number of support.
Some countries export a lot more than they import, and vice versa. Those who export more have trade surpluses. China has the biggest. In 2023, it had a surplus of just under $400 billion US dollars. Some of its Asian counterparts, such as Japan, India, and the Philippines, have trade deficits. But no one's trade deficits rivals that of the US. It had a deficit of just shy of $800 billion in 2023. And the US has been running trade deficits for decades. Since the year 2000, its trade deficit has routinely been $400 billion or more per year. In the last few years, it's been just under $1 trillion.
Richard Koo believes decades of trade deficits have severely hurt Americans. His research group has tried to calculate the cost, and they came up with a huge figure.
When you calculate GDP, you add trade surplus, dollar for dollar. You subtract trade deficit, dollar for dollar. The amount of GDP Americans lost as a result of this 40-some years of trade deficit was over 153% of GDP. In equivalent dollars, that's $41 trillion.
He thinks these costly deficits are a direct consequence of the strong dollar.
It was the strength of the dollar which created this massive trade deficits for such a long time. And because government did nothing about it, we ended up having this very protectionist president at the top to protect American workers and the industry. So it's in that sense that I would argue that the dollar was too strong for too long.
But there are many who question how the Trump administration has framed the issue of trade deficits and how they relate to the dollar.
One is Stephen Myron's predecessor as chair of the Council of Economic Advisors under the presidency of Joe Biden. That's Jared Bernstein, who served in the role from June 2023 to January 2025.
You don't necessarily see the trade deficit move in lockstep with a strong dollar. We've had periods with a strong U.S. economy leading to a strong dollar, high trade deficits, and really low unemployment. So all of those characters in that play can show up together.
And there's the view that Trump's obsession with trade deficits obscures wider economic contexts.
Trump is very obsessed with trade balances and the U.S. trade deficit. And he believes that foreign countries are ripping us off and we should have a balanced position. And part of getting there involves a lower dollar.
Central to Trump's rhetoric on trade and to Myron's ideas is a pledge to restore American manufacturing to apparent former glories.
American steel workers, auto workers, farmers, and skilled craftsmen, we have a lot of them here with us today. They really suffered gravely. They watched in anguish as foreign leaders have stolen our jobs, foreign cheaters have ransacked our factories, and foreign scavengers have torn apart our once beautiful American dream.
It's a view that's resonated with many U.S. voters. One person who shares President Trump's views on manufacturing is Judy Shelton. She was an economic advisor to Trump during his first term when he nominated her to the Federal Reserve, before her appointment was blocked due to opposition in the U.S. Congress.
Whole sections of the country who were dependent on industrial production and manufacturing, particularly our auto industry, those regions of the country have been hollowed out as factories closed. And there really wasn't much sympathy for those workers. It was almost sort of a callous, well, why don't you learn computer coding? Why don't you build wind farms? It was a little bit of a, I won't say cruel, but let's say negligent approach. And as it turns out, those workers ended up voting for Trump.
For decades up until the global financial crisis, the share of U.S. workers in manufacturing declined. Back in the 1970s, close to a quarter of U.S. workers were still employed in manufacturing, but the figure plunged in the 1980s and into the 1990s. Further declines in the 2000s saw it hover around 10% by the global financial crisis, where it roughly remains.
Shelton and others believe that countries managing their currencies against the dollar going back to the 1980s allow them to hold up their manufacturing bases at the expense of the U.S.
I can recall in the 1980s, currency manipulation was actually a huge bipartisan issue in the United States government, where Democrats and Republicans were saying, you know, it's really not fair to our exporters that other countries can debase their currencies relative to the dollar. And I think since China has come on so strong, and we've seen the yuan depreciate against the dollar, that's been particularly hard. And as a result, our country is flooded with cheap imports from China.
Because Americans used to produce lots of televisions, cars, household appliances, stereo sets, all sorts of things. But if what they produce cannot be sold at the competitive prices that the Japanese or Germans are coming in, then even if they have the capacity to produce it, they won't be able to sell it. And I think that's how it all happened over these years.
But there is another view. Jared Bernstein has sympathy for the argument that free trade has hurt workers in the U.S. and elsewhere, but he says Trump's policies will not restore U.S. manufacturing.
The Trump tariffs are being sold to the American public as pain now in terms of higher prices, higher costs on our imports, and gain later in terms of reindustrializing America, bringing manufacturing back. And there are many reasons why I believe that's a false promise, why that won't work.
He says developed countries such as Germany, which have trade surpluses, have also suffered deindustrialization. And it's true. While manufacturing has declined as a share of total employment in the U.S., that's a common story across the developed world. In fact, the U.S. current rate of manufacturing employment as a share of total employment, at or just below 10%, puts it in roughly the same position as many countries in Europe, South America, or Asia. However, China, which still has close to 1/3 of total employment in manufacturing, has the highest share in the world.
Look at countries that have very different levels of trade deficits. And as economies advance, they tend to move from manufacturing to services, and that's fine. That's not a bad thing. But reindustrialization doesn't look to us like a plausible scenario at the end of it. So instead of being pain now, gain later, it looks to us like pain now, pain later.
Yet, while many agree that a return to the manufacturing base of old is unrealistic, there is a view that dollar devaluation is still needed to restore a sense of balance around trade.
I don't think we'll ever get back to the world we had in 1970s. But what we have to do with the exchange rate adjustment is to reduce the number of people in the United States who consider themselves losers of free trade.
That brings us back to the beginning and to a major part of Myron's argument, that the dollar's reserve currency status keeps its value too high relative to other currencies.
That role does come at a certain cost to the U.S., as Mark Sobel explains.
If country X has dollar reserves, they're getting interest payments on that, right? And that adds to pressure on our capital markets. It adds to the U.S. interest bill, which is very high.
But it also brings significant advantages, from lower borrowing costs for the U.S. government to reduced foreign exchange risks to support for the U.S. financial system.
One of the reasons the dollar is the world's reserve currency is the openness and liquidity and depth of our capital markets. People can bring their money here, they can bring their money out, no problems, and they know they'll be protected by good rule of law.
One of Myron's proposals is to have foreign bondholders, that means investors who loan the U.S. money and then hold bonds issued by the U.S. government, to convert short-term, high-interest bonds into long-term bonds that the U.S. won't have to pay much on.
So that would reduce the financing pressures now of our interest bill, and that would help our fiscal situation. But again, why would an investor go out? Why would an investor do that?
Well, this Mar-a-Lago argument also have this notion that other countries have to hold zero coupon, U.S. Treasuries or something. That part I don't think will fly under any circumstances, because each country do have their own sovereignty, right? They cannot be forced to hold these things.
But Judy Shelton and Richard Koo do believe that a Plaza Accord style of restructuring global exchange rates should happen, and that it could limit Trump's desire for tariffs.
Why don't we consider this option? Maybe we can use the tariff as some sort of a kind of a deal-making tool to get people to come in and actually sit down and try to do something about this. But the final solution for U.S. trade deficit problem has to be the dollar correction.
We need to talk about free trade in the context of a rules-based approach. And we have in currency markets a free-for-all. And I think that the trade relationships are a reflection of that, because certainly, look, you don't have to call it currency manipulation. Let's just call it no-fault currency shifts. Nevertheless, it has negative consequences for the country that suffers through no fault of their own.
In fact, Judy Shelton might have been one of the first people to actually come up with the idea of a currency powwow at Mar-a-Lago. Writing for the Financial Times back in 2016, she raised the idea of Trump bringing back the gold standard, writing, "No one anticipates that a Bretton Woods-style conference will soon take place at Mar-a-Lago, the exclusive Trump resort in Florida. Still, as Mr. Trump often urges, it's time to start thinking big once again."
I might have been among the first to say, if we have such a conference in the future, or an effort to have a stable international monetary foundation to carry out the logic of free trade in that Adam Smith sense of comparative advantage, if it takes place at Mar-a-Lago, great.
But Jared Bernstein says the famous summits of the past had very different contexts to the world of 2025, namely a spirit of cooperation and mutual concern.
For that to happen, accord means getting together and agreeing, which is actually what happened at the Plaza Hotel. Getting together with other countries, cooperating and agreeing. Have you seen President Trump in action on the global stage? Does he seem like an accord guy to you? And the answer to that, if you've been paying attention, should be no. So doesn't really, I think that's why I don't really believe that there's going to be anything like that happening.
Then there's the key question of central banks' independence from their governments and their desire to pursue their own currency's interests.
The ECB, the Fed are independent. They target inflation, not exchange rates. The major financial authorities are free floaters. They don't really believe intervention has a lasting impact. Another issue is that countries' cyclical positions vary, and countries are going to pursue their own self-interests.
As with many issues in the Trump era, polarization has come to define economic debates. But those who agree with the Mar-a-Lago Accord idea or with Trump's agenda in general believe they're serious proposals.
If everyone approaches it by taking a breath and saying, let's have an ethical and orderly international trading system based on a stable monetary order, these could be worthy objectives and perhaps even entice some of our trade partners into the same pursuit.
I have spoken to many currency officials, China, Japan, and elsewhere, and they all agree that this is a great idea. The question is, who's going to be the leader to do it?
But those who disagree say the issue is not just wrong-headed, it's economic make-believe and fantasy.
There is no Mar-a-Lago Accord, okay? It's like the Loch Ness Monster. People talk about it a lot, but no one's ever seen it in terms of really policy implementation.
And then there's a view that there's simply no plan, that talk of accords and grand projects is just a way to make sense of something fundamentally lacking.
There's a thing that people sometimes do, especially sort of complex thinkers, and economists, that they look at an administration like the Trump folks and they try to make sense out of it. They try to make it fit into something sensible and rational. It's almost a defense mechanism, and frankly, I kind of understand that on a psychological level. I wouldn't go there with this team. It's very chaotic, it's very transactional, it's on today, off tomorrow. So don't try to impose coherence on this agenda.
Coherent or not, the agenda rolls on. And while many disagree with Trump vehemently, they recognize that much of his success has roots in economic discontent. Yet finding common cause to solve these problems in an era of division, rancor, and name-calling, that remains elusive. And that's it for this episode of Business Beyond. Please let us know what you think in the comments. Until next time, thank you for watching and take care.